Hi everybody, this is Thomas Wynn from Wynn Capital with the first quarter market summary. On the screen is all my contact info. Please connect anytime if you have any questions or comments. As always, let's take a look at the S&P price chart to get some context about how stocks did during the quarter. On the screen now is the S&P 500 ETF, the SPY, and it shows price action from late 2020, all of 2021, a very volatile and down year in 2022, and now the very, very quick recovery from the previous lows, really close to getting back to the old highs. So let's do some quick math with the software. That data box does the calculations. From the bottom to the top was a 27% decline. From the bottom to the current price early in the third quarter, we've had a 31% rally in stocks. And if we reverse and we start looking at where we are, you can see we're just about 5 percentage points away from the all-time highs, which is pretty amazing. We're up about a little over 3% in the third quarter so far. If we look at the where we ended the third quarter to the end of the first quarter, equities were up almost 9%, and for the year to the end of the second quarter, equities are up about 17%. So very, very strong rally. And as I said before, from the bottom to the end of the second quarter, about 27%, 30% overall. So that's where we've been. If we now look at the normal returns for a lot of categories for the quarter, and here is the second quarter, all returns except for bonds were up. If you want to know what the averages are, the average return for quarters are here, best quarters and worst quarters, but strong returns for the second quarter across most categories. This is the same data, all the categories along the top, but the 1-year, 5-year annualized returns. So the 5-year annualized returns for equities in the US is over 11%, 1-year returns about 19%, 10-year returns for U.S. equities 12%, and then across all of these are all annualized returns, with only 2 categories showing negative returns. So a strong market was weak for a year and then has gone right back to being strong again. This is just for the quarter, for the end of the first quarter to the end of the second quarter. The path of the market, which is rising, with not too many dips, and then the news that came out along the way. Some positive, some negative, but in general, prices show what investor sentiment is, and investor sentiment remains bullish despite Ukraine war, high Fed funds rate, potential inflation, all the other news that is being overcome by investors' positive outlook for future prices. A similar thing for much longer period, and just the path of the market and the news that accompanied the path. Again, it starts over on the left and it's ending higher, so over that period, much improved performance. Now we're going to just dive into each kind of category a little bit. U.S. stocks, very, very strong growth for large cap growth, which is mostly tech stocks. Small and value companies did well, but not as good as large growth. The tech companies got killed in 2022 and they're bouncing back really strongly. We overweight small companies and value stocks, so we shouldn't have done that well in equities, but we did do well because our tilt is not that great. It tends to help us when they do well. It doesn't hurt us that much, and there's other ways that we can grind out good returns. And then for much longer periods, you can see all of the categories and the long-term annualized returns down there. For international developed, like Europe and Japan, other developed countries, it was the opposite. Value did better than growth, although growth did better than small cap. Again, the returns for long periods are down below. Emerging markets, small and value led the way as far as categories. China is in this group and really dominates the emerging markets because their economy is so big, but they're not considered a developed country yet. And down below the grid has long-term returns. In the country returns, the U.S. was close to one of the best, and about a third of countries had negative returns, and the rest had positive returns. And real estate has been volatile. When interest rates went up, it really hurt U.S. and pretty much all real estate all over the world. But for 2022, the real estate index was down 29%. We have real estate funds in our diversified mutual funds. We have real estate exposure in there, but we concentrate our real estate investments into alternative assets that have been selected to provide stable income, and their returns look like this almost every year. So doing really well and stable and eliminating a lot of volatility and doing their job. Commodities super volatile. Sometimes we have 40 and 50% rallies and declines. Big split again. A few commodities were up, but most were down, and this has contributed to the very, very steep decline in inflation from whatever it was, 8-9% at the height, all the way back down to 3% and really close to the Fed's target of 2%. That should mean the Fed is going to be reducing rates in the near future, but the future, as always, will reveal itself, and anything can happen in the coming days and months. In the fixed income and the bond market, I highlighted down here that the U.S. government bond has got really poor returns. That is always the case when you have a nearly 40% decline in the long bond price. I think it went from 176 to 90. So that is reducing all the returns for all these periods, but bonds are starting to show a little bit of life and having positive year-to-date returns and one-year returns for most categories. The graph up here is showing short-term rates are close to 5%, long-term rates are closer to 3-4%. The Fed is keeping rates high in the short term, but investors don't believe it's going to endure, so long rates are low. When short rates are higher, this is called an inverted yield curve, and that's what economists are talking about right now. This is the end of the report editorial produced by Dimensional Fund Advisors, and it's basically talking about the positive effect of holding on to a diversified portfolio, trying not to get spooked out of the market, and what happens if you hold things over a long period of time. Once you get big numbers and it starts, any number will start to compound, but through your life, if you're holding it, the compounding that happens in the latter part of your accumulation phase, it has huge effects. That's basically the philosophy we have. We're trying to keep everybody in our seats and invested in at least in a minimum of, or an appropriate amount of equities. That's it for now, and I hope you guys find this helpful. I'll be sending out reports to clients shortly, and if you have any questions, you're welcome to get in touch with me anytime. Thanks a lot, and I'll talk to you soon. Bye-bye.